Hello. Chalo. Now, everyone, are you ready? Just can you inform me about the video, audio? Is everything fine or not? Once you will inform, then we will proceed. Okay. And I just want to inform you that the student who are using our app, CJ Academy app, means those who are registered for the courses and they are using the app, they can ask all the doubts in the chat box. Okay. Understood? During the classes, whatever doubts you are having, so ask me the doubt in the chat box. And those who are not using the app and they are using YouTube Live, so I just want to inform you that this YouTube Live will be only for 3 or 4 lectures, and after that you need to come into the app only. So I will suggest to you that if you have already logged in the app, means you have already registered in the app, then start using the app. Okay. So those who are using the app, just send me a hi message in the app. In the app it is live English 2. You need to join live English 2. Now what I am just informing that now in your app you will be having only one live lectures day 2 that you join. Okay, so in your live lecture there will be one day 2 that you join. Now after, I think now it will be showing join day 2. Now is it showing? Inform me fast so that we can start the class. Everyone, now if you are facing any technical issue, just connect our team today only, because after lecture number 3 or 4 you will not be having any lectures in YouTube. If you are facing any problem, just connect our technical team. Okay, so today we'll start our class. Even though if you are not right now able to access our CJ Academy app, you can listen the class in YouTube. Okay, can we start? Chalo, now very good morning everyone. How are you all? Everyone fine? Super. So today we are going to start our lecture number 2 for CA Final Financial Reporting Saaransh Power Batch. Last class we have completed our lecture number 1. In that we have discussed the introduction of Ind accounting standard. Now I hope you all have understood what actually Ind AS is and what can be the possible difference between Ind AS and IFRS. Right now we have not discussed any carve out and carve in. That will automatically discuss when we will go to what? Individual Ind AS. Okay, now also we have discussed in the last class the roadmap. Roadmap for the applicability of Ind AS to various companies. That I hope you have understood. In that chapter, if you have any doubt, I have already informed you that you need to complete all the questions whatever I have not done in the class by the end of a day. Means once the day is completed, before that you should complete all the questions and it will not take much time. And the sequence also I have informed you that there is category 1, category 2, category 3. First you need to complete category 3, then start with category 2. Then if time permit do category 1. Okay, so in the question bank we have how many category? 1, 2, 3. One is very simple that you can do by your own. Even though you have not read it, you can attempt that type of question in exam. So first start with category 3. If I have not done that question in the class, then category 2 and then category 1. Got this point? Now today we are going to start our first index, that is index 37. The sequence will be as per my what? Way of teaching. I will not start with index 1, then index 2, then index. Okay, not like that. So I just start with the sequence which will help you to interlink all the index. The first index of our Saaransh power batch will be index 37. And the title of index is what? Provision, contingent liability and contingent asset. Provision, contingent liability and contingent asset. What was the corresponding accounting standard in CA inter class? Do you remember? The corresponding accounting standard was AS 29. Accounting standard 29. Correct? And more or less AS 29 and Ind AS 37 are same. More or less. There are, I will say, very minute difference. If you know AS 29, there is no need to teach Ind AS 37. But then also we need to recap all the point. I will teach you, nothing to worry. Okay. But AS 29, if you know, it means you know Ind AS 37. Chalega, there are some difference that we need to discuss. But we'll discuss each and every point what from the beginning. Okay. Now first question, the title is what? Provision, contingent liability and contingent asset. So what is the meaning of provision? What is the meaning of provision? Normally what happened, what I have understood that even though you have done AS 29, most of the students are actually confused with the term provision and contingent liability. He went to recognize provision and went to disclose contingent liability. One thing we know that if provision will be recognized in the books of account. When I say recognize means it will be recorded. Recorded means we need to pass journal entry. And when we say disclose, it will be disclosed in the notes to account. There is no need to pass any journal entry for that. Correct? So provision will be recognized in our books of account, but contingent liability will be disclosed. That we know. But what actually is the difference between provision and contingent liability? What is the difference between provision and contingent liability, that we need to understand, and when to recognize and when not to recognize. Means if you are not recognizing, then it will be disclosed, then it will be disclosed. Okay. Chalo. This much is the object. What is the objective? Objective is to understand a definition of provision, contingent liability and contingent asset, and then understand the measurement criteria, then understand the disclosure requirement. Then understand the disclosure requirement. Whenever we start any AS or Ind AS, just try to understand. Whenever we start any AS or Ind AS, so any Ind AS deals with first scope. What is the scope of that Ind AS? Scope and objective. Correct. Then we'll discuss about the definition. Definition part. Definition of many terms. For example, in this we'll discuss the definition of provision, contingent liability and contingent asset. Then we'll discuss the recognition requirement, recognition criteria, both initial and subsequent. Both initial and subsequent. Correct. Initial means on the date of transaction, subsequent means at each reporting date. Initial means on the date of transaction and subsequent means at each reporting date. Reporting date means balance sheet date. Then we'll discuss the measurement criteria. Measurement. What should be the measurement value? At what value it should be recognized? Correct. Or at what value it should be disclosed? That is the measurement criteria. Both initial and subsequent. And at the end, we'll discuss the disclosure requirement. Disclosure requirement. So this is the what? In any Ind AS, we'll discuss all these things. Correct. Now, normally what happens, just try to understand. When we say accounts, so accounts means what? Accounts means journal, ledger, then trial balance, and then preparation of financial statement. Then preparation of financial statement. Normally we think account means this, correct? But try to understand, all the transactions will be recorded as per some accounting policies. Means for recording, we required accounting policies. Accounting treatment is based on accounting policies, correct? Because at what value it should be recorded, for that we require measurement criteria, and that measurement criteria is given where? Under Ind AS, correct? Now means try to understand whatever I am saying, whether provision will be recognized or will not be recognized, whether provision will be recorded or will not be recorded, that will be given under Ind AS. Now when to record, that will be also given under Ind AS. At what value it should be recorded, that will be also given in the Ind AS. And what are the disclosure requirement, that will be also given under Ind AS. Means can I say, if you want to start any accounts, you should know, you should have a complete knowledge about AS or Ind AS. AS or Ind AS. So when we say accounting, the accounting part is means what? AS or Ind AS. Without this knowledge, we cannot start our accounting. And this actually, student think it is theory. It is not theory. Student think it is theory. That is one misconception. This is one misconception that accounting standard or Ind accounting standard is a theoretical part. It is not theoretical part. Your entire financial statement is totally based on AS or Ind AS. AS or Ind AS. Are you able to understand? Are you able to follow me? But when we discuss the Ind AS part, when this you can see, this is the content. So students start thinking the accounting now become theoretical part. It is not actually theoretical. Your entire numerical questions will be based on what? This Ind AS content only. Got this point? So there is no need to memorize it, because in exam they will never ask you what is the meaning of provision. They will never ask you what are the disclosure requirement. But can I say, there may be some case study based question where you are supposed to define the term provision. So you should know, you should have a conceptual understanding about definition, recognition criteria, measurement criteria and disclosure requirement, so that you can write down in your own word. Even though you are writing in your own word, you will get marks. So there is no need to memorize the content. There should not be any muggification यहाँ पर. Understand and try to interpret whatever you have understood in your own word. You will get marks. However, this Ind AS Saaransh book has been designed in a very simple word. Means once you have understood, you can write down whatever has been given in this Ind AS Saaransh book. Okay, sir. Understood this much? Yes, sir. Now, coming to the definition of provision. What is the meaning of provision? Provision means what? If you see, provision means what? So provisions are actually liability. Provisions are liability. Provisions are liability. Means can I say all provisions are liability? But all liabilities are not provision. Provisions are liability. Means provision will be shown in the balance sheet in the liability side. So provisions are liability, but all liabilities are not provision. Have you understood? So any liability which require estimation, are provision. Means any liability which does not require any estimation, it is not a provision. For example, if you have received some amount from bank as a loan, so for that estimation is not required. You know what is the actual amount. So bank loan is a liability, but it is not a provision. It is not a provision. So any liability of uncertain amount or timing, either amount is not known or the timing of settlement is not known, that become what? Provision. That become provision. So can you say, when I am saying uncertain amount, if amount is not known or the timing of settlement is not known, so there is some estimation required. So it require some estimation. It require estimation. Understood? It require estimation. Now, how to estimate? That is a measurement criteria that we will discuss. So, how to estimate, that is a part of our further discussion that we'll discuss. So, can I say in simple word, provisions are liability of uncertain amount of timing which requires substantial degree of estimation, which require estimation. Very simple, correct? So, provisions are liability of uncertain timing or amount. It means, can I say, to understand the meaning of provision, we should understand the meaning of liability. So, sir, what actually liability mean? What actually liability mean? The liability. You know what is the meaning of liability? Can you inform me what actually is the meaning of liability? Liability means what? So, when I say provisions are liability of uncertain amount of timing, correct? So, liability means liability is a present obligation. Liability is a present obligation. So, what is present obligation? Correct? Means all obligations are not present obligation. So, only those obligations which are present obligation can be liability. So, what is the meaning of present obligation that we need to understand? So, present obligation means any obligation which is probable on balance sheet date, on reporting date. Whenever I write down R date, it means reporting date. So, if the obligation is probable means chances are more than 50%, which is more likely than not. So, if the obligation is probable on reporting date, that obligation become present obligation. That obligation become present obligation. Okay. So, liability means present obligation, of course, arising from past event. Of course, arising from past event, we know that we never recognize any future event. Future event are never recognized in our books of account. We recognize only our past transaction and event. Okay. So, liabilities are present obligation arising from past event. The settlement of which, of course, if there is an obligation that requires settlement, the settlement of which is expected to result, means it will be settled in future. Obligation exists. There is an obligation on reporting date, but a settlement of which is expected to result in an outflow of resource from the entity, means it will be settled in future, and the settlement will result in an outflow of resource. When I say outflow of resource, so outflow of asset, it will result in outflow of asset. It can be in the form of cash, it can be in the form of any other asset. So that is the meaning of liability. Can you just once repeat with me? So what is the meaning of liability? Liability means present obligation arising from past event, the settlement of which is expected to result in an outflow of resource from the entity. Now let me take some example. You will say whether it is a liability or it is not a liability. If you see the balance sheet, try to understand. I'm just drawing the balance sheet in horizontal format, but everyone know that for a company we have balance sheet in vertical format. Only to inform you, I'm just drawing balance sheet in horizontal format. So we write down asset this side. All asset will be in this side, and in this side we write down equity and liability. Right now we are discussing liability. We are not discussing equity. Am I right or not? And as per accounting equation, we know that equity plus liability is equal to asset. Equity plus liability must be equal to asset. That is our accounting equation, and then that is only double interest system. Means in the balance sheet, this side, you can see there are two items. One is equity, one is liability. It means, can I say, we need to understand how to differentiate any item between equity and liability. This is a challenge. Means then only we can do proper classification. Means any item which is shown in this side can be either equity or can be liability. Equity is not a liability. It is not a liability. This to you all know now, because for equity there is no obligation to pay. So equity is not a liability. equity is not a liability, correct? So now right now we have done the definition of this liability. Now I'll just give you some example. You'll say me whether it is equity or liability. When I say, try to understand whatever I am saying. When I say equity share capital, so of course equity share capital is an example of equity. When I say equity share capital is an example of equity, correct? Very simple. When I say debenture, so debenture is an example of equity liability. Of course liability. Of course liability. So can you say I have taken two example. One example I have taken equity share capital. So you write down equity share capital this side. When I am saying debenture, so debenture you write down this side. Debenture you write down this side. Okay sir, correct? Because debenture, correct now, it is nothing but present obligation arising from past event which will be settled in future through outflow of resource, So debenture become liability. Now my question to all of you, redeemable preference share capital. Redeemable preference share capital will be equity or liability? You will inform me fast. Redeemable preference share capital is an example of equity. Equity means it will come under the head share capital. When I say liability, it can be either current liability or non-current liability. Got this point? Correct. So when I am saying equity, it will be shown under the head equity, it will be shown under the head share capital. When I am saying liability, it will be shown under the head either current liability or non-current liability. My question to all of you, redeemable preference share capital will be an example of equity or liability. What do you think? Very good. If you are saying liability means you have understood a definition, can I say in case of redeemable preference share capital, it will be redeemed on settlement date. So through outflow resource, so it will meet the definition of liability, but just try to understand in CA Inter used to show preference share capital whether redeemable or irredeemable under the head share capital. There was something wrong in presentation and classification. That will be now corrected under Ind AS. So Ind AS says the redeemable preference share capital, if it meet a definition liability, it will not be shown under the head share capital. It will be shown under the head liability only. Correct? So can you say when I am saying redeemable preference share capital, so redeemable preference share capital will be shown under the head liability. It can be current, it can be non-current. That is the other part. Chalega? Yes, sir. So now I hope you have understood what is the meaning of liability. So when I am saying provisions of liability, liability means what? Present obligation arising from past event, the settlement of which is expected to result in an outflow of resource by the entity. And if that liability is of uncertain amount or timing which require estimation, that liability become provision. Understood? It is as simple as just try to understand when I am saying rent payable. So for rent payable, no estimation required. For salary payable, if estimation not required, that will not be shown under the head provision because that are pure liability. But when I say, just try to understand, if any amount which is payable and that require estimation, that become provision, that will be shown under the head provision. It can be current, it can be non-current. That is something other part. I hope you are understanding. Correct. So what is the meaning of present obligation? Already we have discussed. Any past event is deemed to give rise to a present obligation if it is probable, that is more likely than not. Probable means chances of occurrence of that event is more than chances of non-occurrence of that event. So if the chances of occurrence are more than chances of non-occurrence, it is probable. Chances of occurrence more means the probability is more than 50%. Correct? It means, can I say on reporting date we need to find out whether we have a present obligation or not. But can I say all past event will not give rise to obligation or present obligation reporting date. So any past event which give rise to obligation या present obligation on reporting date, that event is known as obligating event. Means this chapter will start with the obligating event. If there is no obligating event on reporting date, the chapter will not start. the chapter will not start. So those past events which give rise to obligation on balance sheet date are obligating event. It means, can I say, there must be some obligating event on reporting date, then only we'll think about provision or contingent liability. Provision or contingent liability. Understood? Yes, sir. Now, when to recognize the provision? Ind AS 37 says that there are three conditions. If all the three conditions are satisfied, we recognize provision. Recognize means will pass journal entry. Recognize means will pass journal entry. Okay, sir. So, if all the three conditions are satisfied, first condition is what? There must be present obligation arising from past event. There must be present obligation arising from past event. Second condition, outflow of resource which is required to settle the obligation must be probable. Outflow of resource must be also probable. Once again, probable means chances are more than 50%. It means when I am saying present obligation, it means obligation must be probable. And second condition says outflow must be probable. If obligation is probable but outflow is not probable, we can't recognize provision. So both first condition, second condition says about probability and it should be probable. But first condition is what? Obligation must be probable. Second condition is what? Outflow of resource must be also probable. And of course, if both the conditions satisfied, then can I say whatever amount that must be estimated. If you can't estimate, then can I say we can't pass journal entry. So you require one estimated amount. So whatever estimation is required, you can do that estimation reliably. Correct? A reliable estimation can be made for the amount or the timing of the obligation. For the amount or the timing of the obligation. Understood? All these three conditions satisfied. If all these three conditions satisfied, we recognize provision. So what is the first condition? There must be present obligation arising from past event. There must be present obligation arising from past event. Outflow of resource which is required to settle the obligation must be probable. A reliable estimation can be made for the amount or timing of the obligation. Understood? Let me take one example. You will say whether provision can be required. Provision is required or provision is not required. Provision is required or provision is not required. Understood? Yes, sir. Correct? A very common example. Suppose you have a office, you have a CA firm and you have many employees. Means you are a chartered accountant and you have many employees. Correct? Understood? Now what happened? In the financial year 25-26, there was some amendment under in Income Tax Act and the entire act has been changed. Correct? It means now this employee required training. Training means what? Outflow of resource. Training means what? Outflow of resource. Training means outflow of resource. The question is that in this case, whether provision is required or not for this particular obligation, because that may result in what? Outflow of resource. The question is that this outflow of resource is probable or not probable. Means you need to identify whether this is probable or not probable. Are you getting what I am saying? Probable or not probable. Understood? If it is probable, then of course there is a present obligation arising from past event, outflow resource probable, and of course amount can be estimated. Just try to understand from examination point of view. If the question is silent about estimation, always will assume that amount can be estimated. Correct? If the question is silent about amount of estimation, okay sir, in any example, if I am not giving you the amount, it means amount can be estimated. We can estimate any amount. Are you able to understand? So third condition will be deemed to be satisfied. Just write down, if the question is silent, third condition, if question is silent, then third condition is deemed to be satisfied. Third condition is deemed to be satisfied. Okay, sir. Chalega. So what is my example? Example is what? Ki, if this outflow resource is probable, then recognize provision. And if it is not probable, then do not recognize. Now my question to you all, whether this outflow of resource is probable or not, means can I say you need to find out whether this outflow is avoidable or unavoidable. Means can you avoid this outflow? Whether this expenditure is avoidable. Correct? Means when I am saying expenditure is avoidable, it means it depends on future conduct of business. Future conduct of business means right now we don't know whether this employee will be trained or will not be trained. It is quite possible we have some internal department which can train this particular employee. So we are not supposed to hire some expert from outsider. Correct now? It is quite possible not. It means can I say, of course there may be some outflow resource, but right now it is totally depend upon future conduct of business, and this expenditure is avoidable and therefore outflow is not probable. Therefore outflow is not probable. So in this case actually this outflow is not probable and therefore do not recognize provision. Do not recognize provision. Have you understood this part? Have you understood this part? After each example, when I'm asking have you understood or not, just respond. Even though you are listening recorded class, just say yes sir. When you are saying yes sir, it means you are understanding. When you are saying no sir, it means you have not understood. Then that moment you need to ask me doubt. If you are in the live class, ask me doubt immediately. If you are in the recorded class, just after the class, just write down somewhere this point you have not understood. After the class, you can ask doubt in WhatsApp group. Are you able to understand? So when I am asking, have you understood? It means you need to respond yes sir or no sir. Yes sir or no sir. Have you understood this example? So what I said, ki there was a CA firm. I am just repeating. CA firm. There were many employees. There was amendment in Income Tax Act because entire act has been changed. Now this employee required training. Training will result in outflow resource. Now, this outflow resource may be either probable or it may be not probable. So you need to identify whether it is probable or not. So when I am saying probable means you need to identify whether this expenditure is avoidable or not avoidable. Means expenditure is avoidable or unavoidable. So of course, can you say this expenditure is avoidable because it depends upon future conduct of business. It depends upon future conduct of business, and therefore this outflow is not probable and there is no need to recognize any provision. There is no need to recognize any provision. Why? Because second condition is not satisfied. Second condition is not satisfied. Understood? It can be contingent liability and for that disclosure required. But right now I am not discussing about contingent liability. I am only discussing about provision. I hope you are understanding my emotions. Have you understood this particular point? Let me take one more example. This example normally we take in CA Inter also. Second example. Correct? Suppose you are into airlines business and you have an aeroplane. Don't think or don't comment about my drawing. Okay, aeroplane. Correct? And this aeroplane is used for public transportation. Now as per National Aviation Act, there is one act. It can be any act. Okay, as per this act, if you are into commercial business to run this aeroplane for the public transportation, then as per this act, after 3 to 5 years, from the date of purchase, it require major inspection. Major inspection means what? For this aeroplane, each part require inspection. If I am saying each part of this aeroplane require inspection, it means to avoid any accident. And can I say it will be a major expenditure? Let's say major inspection of, let's say, 5 crore. Major inspection, and this will result in an outflow of 5 crore. Now the question is that whether this outflow is probable or not probable. So when I am saying yes, there is a present obligation arising because of this act. Once you have purchased the aeroplane, this become past event, and once you have purchased and you are using for the commercial purpose as per legal obligation, you have a legal obligation. What? Legal obligation. Yes, for this major inspection after 3 to 5 years. So there is a present obligation arising from past event. Now whether outflow of resource. So yes, there is an outflow of resource. Outflow is there. Now the question is that whether it is probable or not probable. Now the question is that you need to identify whether it is avoidable. Avoidable. Yes, it is avoidable, because this also depends upon future conduct of business. This also depend upon future conduct of business, because in future, can I say, you may decide not to use this aeroplane, or you may decide to sell this aeroplane. So if you have decided to sell this aeroplane, can I say the question of outflow of this particular expenditure will not arise. Correct? Now so it depends upon future conduct of business, because in future you may sell this aeroplane or you may discard this particular aeroplane, or you may use it also. But right now just try to understand the outflow is not probable, because it is totally depends upon future conduct of business. So we'll say outflow is actually not probable, and no provision is recognized. No provision is recognized. Understood? Have you understood? These two examples I think will give you better clarification about this particular point. It means, can I say, point number D, if you come to point number D, only those obligations which exist independently, from entity's future conduct of business should be recognized. Means any obligation which is dependent on future conduct of business should not be recognized as provision. Any obligation which exists independently from the future conduct of business, means whatever entity does in future, that will not actually decide about the outflow of resource. Means in that case outflow is what? Unavoidable. Correct? Now means expenditure is what? Unavoidable. Are you getting? In that case provision is required. In that case provision is recognized. So only those obligations which exist independently from entity's future conduct of business should be recognized. In other words, you can read it. Already I have informed you. Now you can see there are two reference questions. Question number 2 and question 34. That of course you can do. Once you have understood the content, you can do it. I'll come to all the questions, nothing to worry, but not now. Because it is quite possible this question may require some other point also. So I will just come to the question, nothing to worry. But what I am saying, once this concept has been completed, you have the reference question. Even though I have not done in the class, you should do it by row. So I will not do in the class, because I know that is totally dependent on the content. If you know the content, you can just read it and you can understand by your own. So that will save our time in the class. Yes or no? Yes, sir. Now, this point you have understood. What are the conditions required for recognition of provision? Now, we are using one word, obligation. Now, obligation are of two types. Ind AS 37 says all the obligation which arises from past event are of two types. One is known as legal obligation, second is known as constructive obligation. AS 29 was silent. AS 29 is silent about constructive obligation. So this constructive obligation, new term in your life. Legal obligation is very simple. Any legal obligation means it arises due to any contract or any act or any other legislative requirement. So it is due to contract, means it will include any contractual obligation. It is maybe due to any legislation or any other obligation law. It can be legal obligation. So when I am saying legal obligation, it may be either due to act or due to any contract. Just try to understand. Right now we have done one contract. As per this contract, I have an obligation to provide services. I have an obligation to provide services, so there is no outflow resource. In my books, there is no liability. Because when I am saying I have an obligation to provide services, so there is no outflow resource. Correct now. But can you say in your books of account there is an obligation to pay, so you have a liability. You have a liability. This is known as contractual obligation. So as per contractual obligation, in your books of account there is a liability. Correct? If that liability require estimation, then it is a provision. Chalega. Or there can be some act, and because of that act we need to pay some amount. For example, income tax payable is arises due to income tax act, that is also a liability. GST payable is also a liability. So it may be either contractual or it can be due to any act. So what is constructive obligation? Now constructive obligation means what? It actually derived from entity's own action. It actually derived from entity's own action. Correct? Means can I say either entity have some past practice, or entity may have some published policies, or entities has made some announcement, and because of that past practice or published policies or any specific statement announcement, there is some obligation. Let me take one example. Right now we have done one contract that I will teach you and you will learn from me. And during the class I have made one announcement. What is the announcement? That any student who scored more than 90 in CA final financial reporting paper in any exam conducted by ICI, I will give a reward of rupees 1000. I'll give a reward of rupees 1000. This is the announcement made in the class. So can you see this is one specific statement? What is the announcement? That any student who score 90 or more than 90, this is what? A announcement which I have done. Means I am saying true. So you need to write down somewhere that if you score 90 or more than 90, I will give a award, cash award of rupees 1000. Cash award of rupees 1000. Are you getting what I am saying? So one specific statement is there. Correct? And because of this specific statement, there is one obligation in my books of account. So it derives from my own action. It derives from my own action. But right now I don't know how many of you will actually score more than 90. Yeah, 90 or more than 90. It means it requires estimation. It requires estimation. Are you getting? So this is known as constructive obligation based, because there is no contract here. It is only an announcement. So there is no contract. There is no act involved here. But this arises due to constructive obligation. I hope you are able to understand. So what is the meaning of constructive obligation? Constructive obligation derived from entity's own action. It may be due to past practice. Past practice in the previous batches also I have done such type, I have given such type of award. So it means you have a valid expectation that in this batch also I may give that type of award. So it may be due to past practice or published policy, or these particular policies have been already mentioned in my website. Correct? Quite possible, even though I have not done any announcement, but that has been already mentioned in my website. Or I have done some specific announcement which indicate that entity will accept, accept the responsibility. Means I will accept my responsibility and create a valid expectation, on the part of other party. Can I say, once I have done this announcement, you have some expectation from me, and you will start working hard in effort. And if you score 90 or more than 90, can I say, you have an expectation that I will give a cash award. Because of that reason, it become a constructive obligation. And for constructive obligation also, we need to recognize provision. So it can be either legal obligation, it can be what? Constructive obligation. Understood? Have you understood? Batao. This point, have you understood or not? Yes, sir. So now you have understood that obligation can be legal obligation, it can be constructive obligation. Means when I am saying first condition, there must be present obligation. So there must be present obligation. This obligation can be legal obligation, it can be constructive obligation. So there can be present legal obligation, or there may be present constructive obligation. Understood? Chalega? Yes, sir. Any doubt? No doubt. Okay, this much I hope you are understanding. Correct? Okay. Now, one clarification has been given by Ind AS 37 that always an obligation involve other party. So any obligation involve other party because there must be some other party. But the identification of that other party is not required, yeah, not essential for recognition of provision. Even though you don't know the identification of that party, even though you don't know the name, address of that party, correct now. If the obligation is probable and outflow is probable, you are supposed to recognize the provision. You are supposed to recognize the provision. It is not essential to know the identification of the other party for recognition of provision. Chalega? Yes, sir. This is very simple point. I think no explanation required. Understood point. Now, this point is very, very important. Point number F, legal obligation. Right now, we have discussed that obligation can be legal obligation or constructive obligation. Legal obligation can be due to contract or due to act. So, we are discussing about legal obligation which arises due to act. Now, act means, can I say, act must be enacted. If the act is not enacted, so of course, there is no legal obligation. So, some clarification has been given. What is the clarification? Legal obligation arises only when the legislation are enacted. Enacted, can I say, by the end of reporting period? Is enacted on or before reporting date? Enacted, or it is virtually certain. Virtually certain. So, what is the meaning of virtually certain? Virtually certain means it is near to certain. So, virtually certain means chances are more than 95%. Where the chances are more than 95%, we call it virtually certain. Where the chances are more than 95%, we call it virtually certain. Okay, sir. Yes, sir. So, legal obligation arises when the legislation are enacted, or it is virtually certain by the end of reporting period. By the end of reporting period, that it will be shortly enacted. Sir, not able to understand. Let me explain. Let me explain with one more example. One more example, we are discussing about legal obligation. Legal obligation, correct? Suppose this is 31st March. This is reporting date. Reporting date. And this is the next year, next financial year. Now, there can be three situations. First situation, write down. Suppose, let me create one case study. Suppose in the past, due to your business or due to your industry, whatever industry you are polluting the environment, polluting or destroying the environment. Okay, means already there is some pollution. You have created lot of pollution. It can be water, it can be what, air pollution, whatever pollution. And on or before reporting date. Situation number 1, act for cleaning the environment is already enacted on or before 31st March. Already enacted on or before 31st March. The act is already enacted. So right now we are assuming that all the three conditions satisfied. There is a legal obligation. Of course, there is a legal obligation because act is already enacted on or before 31st March. There is no doubt there is what? No legal obligation. There is a legal obligation on 31st March. Yes or no? So there is a legal obligation arising from past event. Outflow must be probable. Yes, it is probable. An amount can be estimated, that we are assuming. In this case, if all three conditions are satisfied, provision is required. Chalega. Situation number 2. Act is not enacted. on 31st March, on or before 31st March. But it is virtually certain. VC means virtually certain. Write down VC means virtually certain. It is virtually certain that such act will be enacted soon. So it is virtually certain on reporting date. That virtual certainty we have on reporting date. Are you getting? Just write down. It is virtually certain on reporting date. That such act will be enacted soon. Enacted soon means after reporting date. So how we'll understand that this is virtually certain? Just try to understand. In India, when we say act is enacted, it means, can I say, the bill has been passed in both the houses, and then bill has been signed by president, and then it has been notified in the official gazette of India. Correct na? Simply speaking, this is the process. The first bill is passed in both the houses, then it will be signed by president, and then it will be notified in the official gazette of India. Once it is notified in the official gazette of India, we say act is enacted. But just try to understand, in India, the sign of president is a formality or not? Yes, it is formality. President is only formality. President in India is only for giving awards. Are you getting what I am saying? With due respect to president, I am saying this. So in India, just try to understand, if bill has been passed in both the houses, it is virtually certain or not? It will be enacted. Yes, it will be enacted. So it is quite possible on 31st March, on or before 31st March, the bill has been already passed in both the houses of parliament. Only what is left? The sign of president is left, and notification of that particular bill in the official gazette of India is left. So can you see, it is virtually certain, chances of more than 95% that it will be enacted. So in this case also, provision is required. Provision is required. Chalega. Situation 1, situation 2 you have understood. Correct? Whether it is virtually certain or not, it is a matter of judgment. It is a matter of judgment. But from examination point of view, just try to understand, they will always indicate whether it is virtually certain or not. Means they will give some indication. Nothing to worry about that. And suppose if you have doubt, so I will just suggest you to give your both opinion. If it is virtually certain, then what can be the possible answer? If it is not virtually certain, then what can be the possible answer? Correct? However, in exam, don't worry, they will use the word virtual certainty. Okay, sir. Now coming to situation number 3. Correct? Act is neither enacted nor virtually certain that it will be enacted. However, entity has a published policies for cleaning the environment. Understood? Has the published policies. So there is no legal obligation, but in this case I have given you constructive obligation. It means if all the 3 conditions satisfied, provision is required or not. Yes, They can be constructive obligation. There is no legal obligation, but there is a constructive obligation because in this case, entity has a published policies. Published policies, correct? So yes, in this case, we have a constructive obligation and therefore provision is required. I'm assuming that all the three conditions are satisfied. Correct? That assumption I am taking. Last case, if you can write down. Correct? None of the, neither legal nor constructive obligation, then no provision. No provision is required. Very important. This type of question can be asked in exam. Already asked in the past, can be repeated in exam. But I think you have understood what I just want to say about legal obligation and virtual certainty. That you have understood or not? Yes, sir. Correct. There is one reference question, question number 8. If you want to just see the question number 8, I will just read on your behalf. What is given? X Chemical Limited engaged in the chemical industry causes environmental damage by dumping waste in the river near his factory. Means similar type of example. It does not clean up because there is no environmental legislation requiring cleaning up. Because they are not cleaning up because there is no environmental legislation requiring cleaning up. Means there is no act. And X Chemical Limited is causing damage for the last 40 years. They are causing damage for the last 40 years. Nalayak. As on 31st March 2002, the state legislature has passed a path breaking legislation requiring all polluting factories to clean up the river waste already contaminated. Now they have already passed in one act. On 31st March 2002, the former gazetted notification of the law is pending. Means can I say it is giving one indication that only notification is pending. Means there is a virtual certainty. How should X Chemical Limited deal with the situation? The obligating event is the contamination of the water because of the virtual certainty of the legislation requiring cleaning up. An outflow resource is certain. It is possible to arrive at the best estimate cost of cleaning. If it is possible to arrive at the best estimate, so a provision should be recognized. Means already or always will assume that yes, estimation can be done. Then only the third condition will be satisfied and yes, provision is required. Only this much solution is required. Chalega. So can I say this type of question, if I am reading or you are reading, you will be able to understand if you know the content. And therefore most of the question I will not do because it is a wastage of time in the class. I will do only that question which require my support, which require my help to understand the entire solution. Okay, sir? Yes, sir? Yes, sir. This was provision. Any doubt for the provision? Provision, have you understood or not? Bolo. Have you understood the provision? Now, if you have understood the provision, let us come to the contingent liability. So right now, we have discussed about obligation. Obligation means arising from past event. Arising from past event. Okay. Yes, sir. This obligation can be legal or it can be constructive. It can be legal or it can be constructive. Now, from accounting treatment point of view, this obligation arising from past event are of three types. One is known as present obligation. Right now we discuss present. One is known as possible obligation. And one is known as remote obligation. Correct. The present obligation already we understood. Present obligation means what? Chances are more than 50%. Chances are more than 50%. Right. Understood. So what do you mean by remote obligation? Remote obligation means what? Chances are less than 5%. Chances are less than 5%. So whenever there is a remote obligation, what our India 37 says that it is immaterial and therefore you can ignore it. So whenever there is a remote obligation due to materiality concept, we ignore such obligation. So in this case, no treatment. Why no treatment? Due to which concept? Materiality. You all know about materiality concept. Only those information which can affect the decision of the user of financial statement are known as material information. Correct now? So if it is remote, just ignore it. Just ignore it for accounting purpose. Correct. Now if it is present obligation arising from past event, already I have given arising from past event. And with these two more conditions we need to check. Outflow of resource and reliable estimation. So can you see if the outflow of resource, there is an outflow resource and estimation can be made. In this situation, if both the conditions means with present obligation there is an outflow resource as well as estimation can be made, then of course provision is recognized. Recognize provision. Recognize provision. Correct. But one doubt will come, sir. Yes, there can be present obligation arising from past event, but it is quite possible outflow resource is not probable. Or even the outflow resource probable amount cannot be estimated. Quite possible. It is quite possible. Either this is no or this is no or both are no. Correct now. Either of these two condition is not satisfied or both the condition is not satisfied. So in this case, even though there is a present obligation, we cannot recognize provision. So in this case, it become contingent liability. It become contingent liability. And contingent liability require disclosure. Understood? Correct? Have you understood? So can I say in this way, if there is a present obligation arising from past event and either outflow resource is not probable or reliable estimation cannot be made, then it become a contingent liability for which only disclosure is required. Understood? Or there can be possible obligation. Possible obligation means chances are less than 50% but more than 5%. Okay, yes sir. That become possible obligation. Means possible obligation are those obligations which are not probable on reporting date. Which are not probable means which are not more likely than not. It means where the chances of occurrence is not more than chance, means where the chances of occurrence is less than chances of non-occurrence. We can say in this way now. Yes. Sorry. We can say in this way. So in this case, always it will be a contingent liability. Means whenever there is a possible obligation arising from past event, always disclose that obligation as a contingent liability, even though it cannot be measured. Correct? Means whether measured or cannot be measured, that is not required. If it can be estimated or it cannot be estimated, in both cases it will become a contingent liability. This is the what? Understanding part. So can we just make a definition of contingent liability by our own? Can we say in this way, the contingent liability is a present obligation arising from past event which cannot be recognized because either outflow resource is not probable, or reliable estimation cannot be made, or it is a possible obligation arising from past event, or it is a possible obligation arising from past event. Understood? It means, can I say, if you understood the concept, you can create the definition by your own. You can create the definition by your own. Chalega. Have you understood this part? Now let us come to definition. What is the meaning of contingent liability? Meaning of contingent liability is a present obligation from past event which cannot be recognized as provision. Understood? Because either outflow resource to settle the obligation is not probable, or reliable estimation cannot be made, or it is a possible obligation arising from past event. You can just make a full stop here from examination point of view. But what is given? It is a possible obligation arising from past event, the existence of which will be confirmed. The existence will be confirmed only by occurrence or non-occurrence of uncertain future event, which is not wholly within the control of the entity. If you want to add this point, add it. Correct. Now, can you repeat with me? Contingent liabilities are present obligation arising from past event which cannot be recognized because either outflow of resource is not probable, or reliable estimation cannot be made, or it is a possible obligation arising from past event, the existence of which will be confirmed only by the occurrence or non-occurrence of uncertain future event which is not wholly within the control of the entity. This is the contingent liability. I think very much clear. Very much clear. Have you understood this point or not? Have you understood this point? Bata. This point is clear or not? Correct. Recognition. Of course, the contingent liability does not require any recognition, will not pass any journal entry for contingent liability. It requires only disclosure. Unless the outflow is what? Remote. If the outflow is remote, then once again you can ignore the accounting treatment. Got this point? So not recognized but required disclosure in the financial statement. Can I say financial statement include notes to account? So all the disclosures are given in notes to account only. So required disclosure in financial statement unless outflow of resource remote. Yes, if the outflow of resource remote, then once again due to materiality concept will ignore the accounting treatment. I think very much clear. Correct? This much you understood? Only for your understanding, one table is there. Let me come to that table. One summary I have just drawn for your understanding. Means whenever there is any question about provision and contingent liability, whether it is a provision or contingent liability, you need to just think about three conditions. Whether there is an obligation, present obligation, or possible obligation, remote obligation, then what about outflow resource, and then what about estimation, then you need to give conclusion. So can you see, if there is a present obligation, outflow is probable and estimation can be made, it is a provision, no doubt. When there is a present obligation, outflow is not probable, estimation may or may not be made, then also it is contingent liability. Means for contingent liability, measurement is not a criteria. If it can be measured, thank you very much. If it cannot be measured, then also disclosure is required. Got this point? Then if there is a present obligation but outflow is remote, then full stop. Once the outflow is remote, then no treatment. Then you can see there is no treatment. Chalega? Yes, sir. Then obligation is possible. Outflow is also probable. Estimation may or may not be made. Contingent liability. Once again, obligation is possible. Outflow is not probable. Chalega. Estimation may or may not be made. Then also it is a contingent liability. Now, obligation is possible, but outflow become remote, then no treatment. Once the outflow become remote, then no treatment. Last, obligation become remote, then also there is no treatment. Understood this one? I think it is giving better understanding. Now, if you understood this particular point, any question you can solve by your own. Chalega? Yes, sir. Okay. Yes, sir. So we were discussing about contingent liability. There is one last point about contingent liability. This is very, very important. Already one question have been asked in exam from this particular point. What is given? When an entity is jointly and severally liable for an obligation. I think you have read this type of para in partnership firm. If partners are jointly and severally liable for any obligation made in partnership firm. I think you know about this. The part of the obligation that is expected to be made by other party is treated as a contingent liability. Let me give one example. Suppose example, the X Limited and Y Limited are partner in a partnership firm. XY and company. So these two are partners. And their profit sharing ratio is 40% and 60%. Now, partnership firm, there is an obligation of rupees 100 crore. So, this obligation is an obligation of partner because the partners are jointly and severally liable. Correct? Yes, sir. It means what is the obligation of X Limited? It is 40 crore. What is the obligation of Y Limited? 60 crore. Understood? Means for Y Limited, what is liability? Liability. This is 60 crore. And what become contingent liability? Contingent liability, because can I say if X will not pay, then Y need to pay, because Y Limited is jointly and severally liable for entire obligation 100 crore. Got this point? So 40 crore become contingent liability. Same thing you can also mention for X Limited. I have taken example from the point of Y Limited. You can also just answer from X Limited point of view. Understood? Got this point? This liability can be provision if this 60 crore require estimation. So I am not saying this liability is a provision or not. If that 60 crore require estimation, so of course it become provision. Understood this point? Got this? Right now I am discussing about this 40 crore. The 40 crore for Y Limited is a contingent liability. 40 crore for Y Limited is a contingent liability. I think clear. Once again I will read. When an entity is jointly and severally liable for an obligation, the part of the obligation that is expected to be made by other parties is treated as a contingent liability. There is one question you can read by room. Now coming to contingent asset. Contingent asset. Contingent asset is very simple. Contingent asset is very simple. Now when I am saying liability, just try to understand. When I am saying liability, so it means what? Obligation. Obligation. So when I am saying asset, it means what? Means just one second. When I am saying liability, it means outflow. So when I am saying asset, it means inflow. That too you understood. So contingent asset are possible asset. Possible asset. Understood? So contingent asset are possible asset arising from past event. Arising from past event. So any possible asset arising from past event are what? Contingent asset. Very simple definition. Correct? So contingent asset are possible asset arising from past event, the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future event which is not within the control of the entity. Which is not within the control of the entity. Now one doubt will come. Sir, when you are saying about liability, correct, means you can say in this way, when we are saying about obligation means outflow, so either there is a liability or there is a contingent liability. Now in liability, we have bifurcated in two parts. Either if it is, if no estimation required, or estimation required. If no estimation, then we call it pure liability. And when estimation required, we call it provision. But again, this provision is also a liability only. Don't be confused. This provision is also a liability. Students are confused about this. Okay, sir, in obligation, there are three terms: liability, provision, and contingent liability. I will say no, there are two terms only: liability and contingent liability. Liability and contingent liability. Same thing when I am saying about inflow. So there is either asset and contingent assets. Asset and contingent asset. Understood? Are you able to understand? Correct? So right now we are discussing the definition of asset. We are discussing the definition of contingent asset. So contingent asset are possible asset arising from past event. Possible asset arising from past event. Understood? So right now I am defining contingent asset. Contingent asset are possible asset. Possible asset, correct? Possible asset. Now possible asset means what? Means inflow is what? Inflow is not probable. Inflow is not probable. No, no, no. Possible asset, that here only students are confused. Here only students are thoda sa confused. Okay. So I'll take a 5-minute break. After 5-minute break, we will discuss. I think the point of confusion you have understood. So first, so I have created confusion. I have already created one confusion. When we say this, then actually what we have discussed. Now here, if I will not discuss this part now, the doubt will remain forever. We will take a 5-minute break. After 5-minute break, we'll come to the contingent asset. Chalega, 5-minute break. Now, can we start, everyone? Okay. So before break, we were discussing about contingent asset. Once again, let us define what is the meaning of contingent asset given under Ind AS 37. So contingent asset are possible asset arising from past event, the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain future event which are not only within the control of the entity. Correct? So what is the keyword? These are possible asset arising from past event. Possible asset arising from past event. Now, let me first come to the recognition and disclosure part, then only I'll come to the doubt which I created before break. Okay. Now, what Ind AS 37 says for the recognition and disclosure of contingent asset. So, when I say inflow, so if inflow are virtually certain, in this case, what they are saying, if the inflows are virtually certain means chances are more than 95%. So if the inflows are virtually certain, then it is not a contingent asset, then it is an asset. So one clarification is given that if the inflows are virtually certain, then it shall be recognized as an asset. It is not treated as contingent asset, means we need to recognize asset and a corresponding income. So what do you mean by this? We are not able to understand. Just try to understand. When I am saying virtually certain, means it is actually certain only. When it is actually certain, then why you are postponing the recognition of asset income? In that case, what our Ind AS 37 says that it is actually an asset, recognize an asset and a corresponding income. The best example for this, when I am saying inflow are virtually certain, when I am saying inflows are the best example for this is credit sales. Means from our bachpan we are recognizing credit sales. What journal entry we do? Journal entry is what? Debtor account debit to sales. Debtor means an asset and sales means corresponding income. Now my question to you all, in this case, when I am recognizing debtor, whether the inflow is certain or uncertain. Can you say, when I will ask you, when you have done a credit sale, you can't say inflow is certain, but it is not also uncertain. Can you say, in this case, when I say debtor, so there is a right to collect the amount, but that collection is certain. You can't say it is 100% certain, but you can't say it is what uncertain also, because whenever we do credit sales only to those persons who are financially capable and who are known to us. But you can't say it is 100% certain. So in this case, actually it is virtually certain. Can I say, in this case, inflow is virtually certain and therefore we recognize here an asset. It is not a contingent asset. So the example this example we are doing from our Bachman. Only now you are able to understand that yes, in this case the inflow is virtually certain and therefore we are recognizing it as an asset and a corresponding income also we are recognizing. Got this point? Now I hope you will better understand this virtually certain. So what Ind AS 37 says that if inflows are virtually certain, it is not a contingent asset, it is an asset, recognized asset and corresponding income. But if the inflows are probable, then it is not an asset, means you can't recognize an asset. It will be considered as a contingent asset, and contingent asset are not recognized. It is only disclosed in our financial statement. Disclosed in financial statement means in notes to account. However, if you have done AS 29, used to say contingent asset will be disclosed in the report of approving authority, means in director's report. So here there is one difference. However, can I say when I say disclose, disclose will be in finance statement. So this is only the correct treatment. We should disclose whatever we want to disclose in our finance statement. That means it in notes to account. Chalega. So if the inflows are probable, then it become contingent asset, and contingent asset require only disclosure. But if it is not probable, then no treatment. Then no treatment means thoda sa better understanding. When I am saying outflow, try to understand. Outflow, certain. Can I say it is liability? When I am saying virtually certain, then also it is liability only, but we have not used the word virtually certain. Because in that case, if the outflow is probable, then also it is a liability. Liability means provision. You can say it is provision because estimation might be required. Estimation might be required. But it is a liability or not? Huh. When I am saying it is probable, then also it is a liability. You can say it is a provision. Why? Because estimation might be required. When I am saying not probable, then it become contingent liability. And when it become remote, then no treatment. I think you have understood. Chalega. Correct. Now when I am saying inflow, certain. So it is an asset. When I am saying virtually certain, then also it is an asset. However, we have not given a separate name for that. It may also require an estimation. It may also require an estimation. But we have not given any other name for this. This is the only difference. I hope now you are better understanding. But if it is probable, you can say for income we are actually more conservative. And therefore, in this case, we are not saying it is an asset, it become a contingent asset. And that is only conservatism. That is only a conservatism. It become contingent asset. Because for recognition income, we are more conservative. When I am saying not probable, then once again no treat, here also no treatment. And if it is remote, then no treatment. I think now you are better understanding whatever I am saying. This will give you better understanding. Am I right or not? Have you understood? I think whatever the doubt I have created, now it is over. So for asset, means for inflow, there are two terms, asset and contingent asset. For outflow also there are two terms, liability and contingent liability. But for this particular point, whenever estimation required, we have given a separate name for that liability, just like provision. But provisions are also liability. Provisions are also liability. Chalega. Understood. This is now clear. This is now clear. Don't worry about virtual certainty. In exam, they will always inform you about virtual certainty. Yes, sir. Summary, already I have informed you. This summary you have understood. Already I have given by writing. Now coming to the next part, that is measurement of provision and contingent liability. So the question is that provision always require measurement. Contingent liability also require measurement. So measurement principle for provision and contingent liability remains same. The measurement provision for measurement criteria for provision and contingent liability remain same. So whenever we are saying measurement, how to measure it? Ind AS 37 says that whenever you are doing measurement, it should be the best estimate. So what do you mean by best estimate? Best estimate means what? The amount recognized as a provision. The amount to be recognized as provision must be the best estimate of the expenditure, best estimate of future expenditure. Of course, it is future expenditure. Best estimate of future expenditure required to settle the obligation at the end of reporting date. Best estimate of expenditure which is required to settle the obligation at the end of reporting date. I think very much clear. Means, thoda sa try to understand. We are discussing about measurement. Correct? Now suppose this is our reporting date. Reporting date. And we require provision. We want to recognize provision on this date. Understood? Now can you say, when I am saying provision means a liability of uncertain amount or timing. Means there are two measurements required. First is amount and timing. So suppose timing is what? This expenditure will be payable after at the end of third year. So this become Y0. Y0 is your reporting date. So settlement will be done at this point. Now we need to measure the amount. Let's say as per the best estimate, the amount is what? Rupees 10 lakh. Rupees 10 lakh. So this amount is payable after 3 years, means at the end of the 3 years, and the amount is 10 lakh. So this requires an estimation you have done. My question to you all, at what amount you recognize this provision at Y0? Can you say this must be at present value? Present value of future expenditure. So this will be present value of future expenditure. Present value of future expenditure. So this must be present value of future expenditure. Understood? So it means, can I say provision will be recognized at a discounted amount if the time value of money is material. Means what Ind AS 37 says, if time value of money, TVM means what? Time value of money is material, we should recognize at a discounted amount. But if time value of money is not material, it is quite possible settlement is required after 6 months only. Correct? In that case, we can recognize at an undiscounted amount. Are you able to understand? Then it will be recognized at an undiscounted amount. Undiscounted amount. Means from examination point of view, I will say whenever rate of discount is given, it means it is material. Correct? So if the rate of discount is given, then what? Discounted. If suppose if in exam rate of discount is not given, so you can't assume rate of discount by your own. In that case, we'll assume time value of money is not material. If rate of discount is not given, then we'll not say the question is not correct. We'll assume that time value of money might not be material. Understood? Correct? So what Ind AS 37, that amount recognized as provision shall be the best estimate of future expenditure required to settle the obligation at the end of reporting date. Means if the obligation is settled today, how much amount is required to pay? That is present value. That is present value. It means provision whatever amount of provision shall be the present value of expenditure if the effect of time value of money is material. Correct? If the amount is payable, within 1 year, if the rate of discount is given, you should discount it. Correct? Now what is material, what is not material, that depends. It is a matter of judgment. Okay sir, if the rate of discount is given, discount it. Understood whatever I am saying? Chalega? Yes sir. But normally what happens, if it is payable within 1 year, we don't discount. If I am saying normally, if it is payable within 1 year, we don't discount. Okay sir. So in that case, they will not give you a rate of discount. Now, just try to understand, exam point of view thoda sa is different from practical point of view. So when you are asking this type of question, I will be also confused. So examination is something different and practical is something different. Practically we apply matter of judgment, but in exam we apply the information given in the question. Are you able to understand my emotions? Bolo. Have you understood this point? The amount of provision shall be present value of expenditure if the effect of time value of money is material. And the discount rate should be pre-tax. The discount rate should be pre-tax. Pre-tax, pre-tax means what? The rate of discount, whatever has been given, should be pre-tax, not post-tax. Post-tax means net of tax. Correct? So if suppose the 10% is given and the rate of tax is 30%, then 7% become post-tax and this become pre-tax. So pre-tax discount rate should be pre-tax, not post-tax, because can is a provision is a charge against profit before tax. Okay, see, provision should be measured before tax only, it should not be net of tax. Understood? Provision should be made before tax. Understood? Point number 1 you have understood. Point number 2 you have understood. Point number 3 you have understood. Let me take one question. I'll take one good question. Come to question number 20, I think so. Come to question number 20. I like this question personally, but till now this type of question has not been asked. Question 20. Marico has an obligation to restore environmental damage in the area surrounding his factory. Expert advice indicate that restoration will be carried out in two distinct phases. Restoration will be in two phases. The first phase requiring expenditure of 2 million. 2 million means 20 lakh to remove the contaminated soil from the area. And the second phase commencing 3 years later from the end of first phase to replant the area with suitable trees and vegetation. The estimated cost of replanting is 3.5 million. Means there are two expenditure. One is what? 2 million. This is the expenditure at the end of first year. And this is 3.5 million. This is the expenditure which will commence 3 years later from the first phase. You need to read the question carefully. Then what is given? Marico use a cost of capital before taxation 10%. Means they have given before taxation only. Thank you very much. And the expenditure when incurred will attract a tax relief at the company's marginal tax rate. This 30% has been given only to confuse you. Okay, this 30% is not required. A tax rate is not required. Marico has not recognized any provision for such costs in the past, and today date is 31st March 2002. The first phase of cleanup will commence in a few months' time and will be completed on 31st March 2003, means at the end of first year, when the first payment of 2 million will be made. Phase 2 will be paid 3 years later from the end of first phase. Calculate the amount provided at 31st March 2002 for the restoration cost. Let me explain you. So we are doing question number 20. Question number 20. So actually this is 31st March 2002, this is Y0. Then this is 31st March 2003, this is Y1. This is 31st March 2004. This is 31st March 2005 and this is 31st March 2006. So the second phase will start 3 years after the end of first phase. So this become 3 years. So this become Y2, this become Y3, this become Y4. And the expenditure how much given? Expenditure is 2 million and this is 3.5 million. 3.5 million. Rate of discount how much given? 10%. My question to you all, when you are saying to discounting, you will apply on both amount or only whatever is payable after 1 year. Just try to understand, it is practically wrong if you are saying this will be undiscounted and this will be discounted. Just try to understand, when you are saying discounted, the entire amount will be discounted. When you are saying undiscounted, the entire amount will be undiscounted. It is wrong to say that some amount will be discounted and some amount will be undiscounted. That is wrong to say. That means in this case, what will be your answer? Can you say Y1, Y2, Y3, Y4? This is 20 lakh. This is nil, and this is 35 lakh. Rate of discount, so this is 0.909, 0.826, 0.751, 0.683. This so you can calculate. Then present value you can calculate, and this is the amount of provision. Calculation you can do. I am not doing any calculation. This type of question can be asked in exam. I like this question personally. Understood? Because in this question many students may do mistake. Have you understood this point? Bol Baba. Okay, sir. Clear? Calculation you can do. I know you are expert in calculation. Answer is given. You can read it. Okay, sir. But writer must revise question before exam. MRQ. Whenever I write on MRQ, so this is my expected question, or these are the questions which require some attention just before exam. Okay, sir. Yes, sir. So write down MRQ, must revise question. Must revise question. Okay, sir. Done. So 20 I have done. Just give circle. Okay. Now coming to one second point number 8, best estimate. I hope you have understood कि best estimate of future expenditure required to settle the obligation at the end of reporting period. Now the question arises, how will do best estimate? So what India 37 says that best estimation is nothing but it is a judgment of management. Means you will not ask any question from management. They will decide about the estimation and that will be the best estimate. So estimation determined by management judgment. But can I say as a chartered accountant, yeah, as an auditor, you just require evidence for that particular evidence. So it need to be supported by, means whatever estimation has been given by the management, it should be supported by experience of past transaction. It is quite possible similar transaction was there in the past, so it is based on the experience of past transaction, or a report of an expert, or it is based on the report of an expert. So of course you can rely on that, or any additional evidence provided by the event occurring after reporting date. Event occurring after balance sheet date. I think you have done AS4. Similar Ind AS we have that is Ind AS 10. So that will be based on the event occurring after balance sheet date. So any event occurring after balance sheet date may provide additional evidence which may support your estimation. This third part will be discussed under Ind AS 10. This is our second chapter. Means the next chapter. Understood? So I hope it must be supported by the experience of past transaction, report of an expert, or any additional evidence provided by an event after reporting date. Chalega? Okay, sir. Yes, sir. Now, how to measure? This is very, very important. How to measure? Now, how to measure? There are two methods. One is known as expected value method. One is known as expected value method, and second is known as most likely outcome method. Most likely outcome method. Correct. So what India 37 says that whenever obligation involve large population, in our example, when I have made one constructive obligation, I announce some reward if you score 90 or more than 90 in your final exam of ICI. So can I say in that case obligation involve large population? Then it becomes this case. So whenever obligation involve large population, then determine the expected value of obligation, that is weighted average of all possible outcome. Then in that case we'll apply weighted average of all possible outcome. So what do you mean by this? Let me explain. The weighted average of all possible outcome, don't worry about outcome. Outcome will be given the question. Only you need to apply weighted average. That become expected value of obligation. Let me come to one question. Come to question number 26. Come to question number 26. What is given? Assume that firm has not been operating its warranty for 5 years. So there is some warranty obligation. You know about warranty. Warranty, whenever we made some sale of any goods, so that may be with warranty. Okay. And reliable data exists to suggest the following. If the minor defect occur in all the products sold, repair cost of 20 lakh would result. So if there is some minor defect, the repair cost would be 20 lakh. Warranty means will provide some repairment if there is some manufacturing defect. If the major defect, then cost may be 50 lakh. The manufacturer past experience, as per past experience, and future expectation indicate that each year 80% of goods sold will have no defect. 80% of goods will have no defect. 15% of goods sold will have minor defect. 15% will have minor defect. And 5% of goods will have major defect. So can you see this is based on management judgment and supported by past experience. So this information has been given, but can you say they have given some possible outcome? And the expenditure also has been given. In case of minor defect, this is the expenditure. In case of major defect, this is the expenditure. Now you need to only apply weighted average of all possible outcome. That become expected value of obligation, and that will be the amount of provision. Correct? Calculate the expected value of cost of repair in accordance with the requirement of India 37, if any. Ignore both income tax and the effect of discounting. So they have explained you to ignore the impact of discounting. Just try to understand, always will ignore income tax. Income tax will not be considered. But effect of discounting, thank you very much, we'll ignore it. Are you getting what I am saying? So what will be the weighted average? Can I say 80%, there is no outflow, 80% nil. Then 15% multiply by 20 lakh. Then 5% multiply by 50 lakh. Very simple. Can you say this? So you can calculate by your own, and this become the amount of provision. If suppose rate of discount is given, so we'll do discounting because they have given a warranty for 5 years. So suppose 5 years is unexpired. So can you say we'll do discounting for how many years? 5 years. That will be as per the information given in the question. Chalega. Understood? Have you understood? I think you have understood weighted average of all possible outcome. Weighted average of all possible outcome you understood. This is the only one good question we have. Other question, I think you can do it. Just do it. I have done right now. Which question? 26 I have done. But there is no question for the second part. Most likely outcome method. What India 37 says that when there is a single obligation with only two possible outcome. When there are two possible outcome, yes or no, then in that case, don't do weighted average, apply most likely outcome, and that most likely outcome will be the amount of provision. Understood? The provision is created based on most likely outcome. Let me take one question. I will only create one example. Try to understand this particular example. Try to understand. Suppose there is one legal case is pending. This is 31st March. And legal case is pending. Correct? Now, as per As per expert means lawyer, there are two possible outcomes. 70%, 30%, 70%, 70%, there is chances of what? Loss, and 30% there is chances of win. Can you see, if there is a loss, there will be outflow. And outflow is what? Suppose 10 lakh. So you can see in this case there are only two possible outcomes, and 70%, of course it means there is a present obligation arising from past event. So in this case you will take most likely outcome. The most likely outcome is what? You will not do average here. Whenever there is a two possible outcome, correct. Now in this case outflow is nil. So in this case your amount of provision at an undiscounted amount, we are assuming the rate of discount is not given, the amount of this provision will be 10 lakh. You will not do 10 lakh into 70%. The amount of provision will be 10 lakh. If it is discounting is given, then multiply by present value factor if the discounting factor is given. Understood? Have you understood this point? Have you understood this point? Any doubt? Got this point? Bolo. If I say in this way, try to understand. Same example. Same example. If I give in this way, same example. 31st March, loss, win. In case of loss, high damages, low damages. So this is 60%, 30% and 10%. Understood? And the outflow is high is 10 lakh, low is 4 lakh, and this is nil. So you can see in this case there is a single obligation, but there are three possible outcomes. So in this case you can't apply most likely outcome method. In this case you need to apply expected value of obligation, and in this case what will be the amount of provision at an undiscounted amount, that is 10 lakh into 60% plus 4 lakh into 30%. This will be your answer. And so you can find out. So 4 lakh into 30% how much? Plus 6 lakh. So your answer becomes 7,20,000. Your answer becomes 7,20,000. I hope you have understood. Understood this particular point? The same case I have given two examples. Chalega? Okay, sir. Yes, sir. So this also you have understood. This is very, very important. How to measure? One question may come from this. One question may come from this in what? MCQs also. So point number C we have understood. Point number D we have understood. In point number D there is one point number 4. What is given? Gain from expected sale of asset. Gain from expected sale of asset shall not be taken into account for measurement of provision. Of course, can I say gain from expected sale of asset, that is actually covered under in some other Ind AS. Are you getting? Let me take one example. Suppose, try to understand. Suppose there is one machinery and machinery is damaged and it requires repair. Till now repair is not done, and 31st March. So we need to create provision for repair, and repair will be done after 1 year. Let's say after 1 year. Now, whenever repair will be done, there may be some expected sale of some of the damaged part of machinery, which may result in gain. Now the question is that when you say repair, the repair outflow might be suppose 5 lakh expected, and the expected gain, let's say it might be 1 lakh. So will you consider this expected gain to recognize the provision? Bula no, don't consider. So any expected gain on sale of asset will not be considered for recognition of provision. I think I have just given a very common example. I hope you have understood. So this expected gain on sale of asset is actually covered in some other Ind AS. It is not covered under Ind AS 37. Okay, sir. So gain from expected sale of asset shall not be taken into account for measurement of provision. Correct. Then the last point about measurement is risk and uncertainties. Risk and uncertainties. Just try to understand what is the risk. Risk is whatever you estimated may be different from actual. That is the risk. You estimated some amount, but the actual might be different due to some uncertainties surrounded by that particular event and transaction. So what Ind AS 37 says that for that risk and uncertainty, you need to do some adjustment. Adjustment for recognition of provision. Correct. So a risk adjustment should be made for the amount that entity would pay in excess of. The entity would pay in excess of the expected present value of outflow due to uncertainty attached with the actual outcome. So any excess amount which would be payable when actual amount will be paid. Correct. So of course the excess amount the entity would pay in excess of the expected present value of outflow due to uncertainty attached. Because of that reason, some risk adjustment is required. Now this risk adjustment can be done in 3 ways. This risk adjustment can be done in 3 ways. Either you can add some amount to the expected present value of future outflow. Means whatever present value of future outflow you have derived, add some amount in that, because you need to increase the amount of provision because of that risk and uncertainties now. So by adding it to the expected present value of future outflow, or by doing adjustment to the estimate of future outflow, or do some adjustment in the future outflow amount, or by adjusting the discount rate, or you adjust the discount rate, means not understood. Let me take one example. Try to understand whatever I am saying. Try to understand. I mean, right now I have taken one example of legal case. Let me take that example only. Legal case. Legal case is pending. Now there are 3 situations. High damage, low damage, no damage. Probability is given 60%, 30%, 10%. Outflow is given 10 lakh, 4 lakh, nil. And rate of discount is given, suppose 10%. And let's say it is expected to be settled in 2 years. Expected to be settled in 2 years. Expected to be settled in 2 years. So what they are saying, either you can adjust this outflow amount. Either adjust the outflow amount, adjust it for future risk and uncertainties. Either you can do adjustment here, or you can adjust the rate of discount, or adjust, or I am saying, or adjust the rate of discount, or whatever the present value is coming. This present value will be what? Try to understand. You will say 10 lakh multiply by 60%. It will be 6 lakh. 4 lakh into 30%. 1,20,000 and nil into 10% nil. So it is coming 7,20,000. Then you will do present value factor. Then whatever amount will come, that become present value. Present value. Or you can add some amount in this for the future risk and uncertainties. So either you adjust this, or you adjust this, or you adjust present value as per the information given in the question. As per the information given in the question. Understood? You can't adjust all. So either you, now I think you will be able to understand. I will just read. Risk adjustment can be accounted for in the number of ways, such as either by adding it to the expected present value of future outflow, or by adjusting the estimate of future outflow, or adjusting the discount rate as per the information given in the question. Let me take one question. Only one question. We have question number 6 for this. Come to question number 6. That is given. X solar power plant, a power company, has a present obligation to dismantle its plant after 35 years of useful life. X solar power plant limited cannot cancel this obligation and transfer third party. Means it is what? The expenditure is avoidable, unavoidable, unavoidable. X solar power limited has estimated total cost of dismantling is 50 lakh. The present value, which is the future outflow, and the present value is given 30 lakh. Based on the facts and circumstances, X Solar Limited consider a risk factor of 5%. Risk factor is what? 5%. The risk that actual outflow would be more than the expected present value. How should X Solar Power Limited account for the obligation? Now in this question, what they are saying, based on the facts and circumstances, X Solar Power Limited consider a risk factor of 5%, that is risk that actual outflow would be more than the expected present value. It means this 5% will be adjusted to the present value. It is given. Therefore, your answer already the present value is given 30 lakh. 30 lakh in plus you will do 5%. This will be the amount of provision. With this adjustment you can't do on 50 lakh. You need to do in present value as per the information given in the question. As per the information given in the question. Chalega. Very good question. It is quite possible they have given some discount rate and they say that discount rate should be adjusted for the risk and uncertainty. That adjustment will do. That adjustment we will do. Okay, sir. Any doubt for this particular point? No, sir. Okay, sir. Right now I can of course carry on because some time is left legally, but okay, to this much only. Initial class, I think only the second class, I don't want to teach you more right now, I think, but whatever we have done you have understood. Can you just revise income? Can you just revise income? Correct. Means what we have done the definition part, we have done the recognition and disclosure part, and we have also completed the measurement part. Now only in this chapter some special points are left. Special point means there are 4 special points. One is reimbursement, second is future operating loss, then onerous contract, and then what? Restructuring. Then there are some special points are left. Okay, so this will do tomorrow. More or less the chapter is completed, I will say, but special points are left. Okay, ठीक है. So this much only. Okay, sir. Revise and come all the questions whatever I have not done for the concept whatever we have covered. If you do that much by today now, trust me, FR will become very easy. FR will become very easy. Bye bye. We'll meet tomorrow. Till then, bye bye. Take care and revise the chapter by your own. Okay. Bye bye.